Hi everyone, welcome once again to a webinar of Bricken. I introduce again myself. I'm Ludovico Rossi, Chief Revenue Officer and co-founder of Bricken. And today we will be talking about redefining trust with tokenized assets through credit scoring. Okay, so let me introduce also my colleague Dario Lobuyo, head of blockchain. He's the mastermind behind all our smart contracts, and he is also a co-founder of Bricken. So welcome, Dario. First webinar for you. How do you
Hi
feel?
everyone. Thank you, Lugo. Excited,
And,
excited.
also on the other hand, we have a special guest today that is Darshi from Credora. That he is the CEO. So they are a company from Singapore, but they will tell more about themselves, of course. Welcome, Darshan.
Hey, great to be here. Thanks for having me.
Yeah. So basically, today we want just to face a little bit this topic because we have this new partnership to announce between, of course, Bricken and Credora, and we want to explain to all of you why we are building this partnership, no? And also why we are here today with Dario. Because it's a special occasion. No? So basically, in Bricken, as all of you knows, or maybe if you don't know, we are specialized in tokenizing RWAs, let's say. But what we really do, and we like to say specifically, we are specialized in tokenized equity, debt, credit, future revenue. And today, we are launching actually soon a new smart contract about that specific, and it's been built by Dario. So now we will talk more about this smart contract, why it is special, and on the other hand, also why Credora is a really important piece in order to give trust to this kind of asset in that sense. No, so Dario, the stage is yours, and please tell us more about what we have been building in Bricken lately, and what are all the new feature and new opportunity that this asset is going.
Sure. Let me start with a little bit of context and history because this has been in the work for 1 year already, and we are seeing light at the end of the tunnel finally with these debt smart contracts. Since we started in Bricken, we always went hand by hand with people's and their needs, and that's why back in the times we didn't went with a standard already existing on AWS, and we made our own smart contracts, our own protocol to just supply with the needs of people. And the debt smart contracts are now a natural evolution to what things you can tokenize, and they're pretty much different from equities because they have different mechanics, they have different requirements, and they just must follow different logics, and that's why we also wanted to create a specific set of contracts dedicated to debt. Our approach, both with equity and debt, is always the same: is to build modular protocols that you can easily integrate with already existing technology. So that's why our tokens are mainly ERC20 with many added features. And depending on the use case, you might have different modules attaching to these smart contracts. In the case of debt, the biggest challenge I would say is the debt repayment solutions. You have many possible ways of repaying debts, especially when there are interest in. So you might repay interest early, capital next. You might do a mix of both. You might have different time frames. You might have even interest rate that changes over time because they might be bonded to indexes in the market or many potential sub cases of all of this. The biggest challenge was undoubtedly this, and forging this into immutable code as smart contracts, and that's why also it also took a long time in the back for us. We have it's not just me; we have a team of people behind that has been working on this for the last year. And again, our smart contracts, you will be able to check them out pretty soon, because those are openly scannable on Etherscan and all the block explorers that you want to use. You will see that you will have the options to really customize your debt tokenization using what is an evolution of what we already have for equities. And this will give us also the opportunity to evolve into more things from here, like funds and many more use cases in the short mid term, I will say. Um, the newest features are also with newest designs. We have been looking at the space on how things are built in general in smart contracts, and we have been fascinated with the latest version of Uniswap v4 that introduces some patterns to really modularize your experience on a specific pool, but in this case in Bricken, with our core logic of tokenization. We have been inspiring our code by the best practices out there. We have the best security patterns that continuously audit our code. We are pretty obsessed with the quality of our code in this case, and we're pretty happy we have been finishing this up, and you will see it soon.
Okay, thanks. And this is a little bit too technical, maybe for all the audience out there, but yeah, basically, what we are launching is this modular smart contract that will allow literally to have a tokenized debt, so to issue this kind of financial instruments in a dynamic, really streamlined way, and also it will allow you many different, actually, soon all the payment methods that there are to pay back the debt. No, Darson, for sure, he knows more about all these financial instruments, and you are coming literally from finance, so also you can see a little bit the power of this. No, I have a question. I mean, what is, guys, for you, the difference between a normal contract of debt, I mean, a normal financial instrument, and the tokenized financial instrument? No, because have this. I also had this conversation with Dario. It was like, okay, we're gonna put it only in the front end part, or we're gonna embed it literally into the smart contract, no? And was like, no, literally into the smart contract. So, what is your view about it?
Yeah, I mean, I think I guess we've been in the private credit debt lending space for some time, and we've seen, as Dario was saying, how bespoke the requirements are for lenders and borrowers. Everyone has something different they want to do, and so creating a standardized product has historically been really, really difficult. And that's why I think what Dario was saying was really impressive, in that, like, giving people customizability at the smart contract level has historically proven really challenging for most people in the space. So you tend to see a lot of unification in terms of you can do it one way or another way, and that's basically it. And so giving like a bespoke user experience is something that I think is quite unique. In terms of your question around like the value of having it embedded in the smart contract, I think it's kind of the same value that tokenization generally brings, which is transparency and automation around the whole process. So a lot of the time in private credit, historically, there is lending coming from large intermediaries like credit funds or large lenders or banks. And generally, it's because it's kind of cumbersome to manage lots of different counterparties when you issue debt. There's a lot of manual accounting to be done, and then reconciling to be done. And the promise of blockchain is to abstract that away. And as Dario was alluding to, that's really great in theory, but then to actually make it so that it solves the customer's pain point, which is, I don't want to issue debt in just this one way, is truly the challenge, I think, for on-chain debt issuers. Is like they have some bespoke thing that they want to do versus what the current on-chain smart contracts allow you to do. So certainly I think the natural benefit of doing it all natively on chain is really the same as what the benefit of tokenizing all RWAs, which is increasing transparency, reducing risk, reducing cost, and essentially automation of back office. Yeah, that's my opinion.
I will second what you said, and I would also add that smart contracts gives you the enforceability. You can literally enforce how rules must be met. And this is also a nice solution for what you said, having less reconciliations to be done manually and having streamlined processes. I think that what it can also add, and I don't want again to go to tech about it, is to open also new possibilities. Imagine having your tokens representing debt and using them to collateralize a loan somewhere else in a decentralized lending protocol, for example. You can literally make them smart and have them an utility beyond their final purpose of being or representing just debt. You can literally create new puzzles, new games with them once you got them digitalized in the blockchain.
Yeah, I'd say like that's kind of where we try and come into it, which is to try and quantify the risk and as such like help price discovery. So what is Credora? It's essentially a technology-driven ratings provider for various on-chain assets. I think for a loose analogy, we're trying to be like an S&P or a Moody's of the on-chain space, where we really believe that standardizing the risk can, if you can benchmark everything to a common scale, i.e. like traditional ratings, you can make the investor's job significantly easier. You can make it issuing of debt significantly easier. And then the things that tokenization brings in terms of like what you were saying just now, Dario, in terms of secondary markets and being able to use that debt for some further utility is easier if you have a way of quantifying the risk underneath. So broadly, like what we do that's slightly different to traditional ratings agencies is take a tech-driven approach to producing those ratings at scale. But our goal is similar. It's to unify the risk assessment across all on-chain assets and make it more composable, effectively like a credit oracle or risk oracle of type.
Yeah, this is really important because I mean, nowadays we are seeing, especially in this decentralized world, that it's really easy not to issue any kind of digital asset. So now that we are specializing more into the digital finance and into as well this decentralized world, we really need also to protect the users and the potential investors. So that's also why I really think that you guys in Credora are doing a great job, but you are really an essential part of the sector. I mean, also Moody's is entering, but Moody's, is a monster, and the prices as well. And you guys have a really smooth solution that we like so much. Can you, Darshan, tell us more about how it works, even if someone want to issue a debt, and how can get a credit scores from you?
Yeah, I'd say it's a fairly seamless process on our platform. Any borrower can onboard and basically drag and drop all of their financial data and any other supplemental data, and our AI agents will scrape that and structure it in a way that is consumable by credit models. And then we also look to plug into as much real-time data as possible. So we privately pull real-time data on borrowers that work to validate those numbers in the financial statements and in the documents that have been uploaded. So the cumbersome process of going and manually trying to verify everything is reduced significantly by automating those two things, like structuring the data and then getting real-time asset validation. And then obviously with every debt issuance, there is context. So there is this final 10% that then our credit team is able to analyze the various data points and clarify with the issuer what the various nuances are. At that point, there is a rating that's issued. And and the borrower can distribute it how they see fit. And they can also make that rating available on chain. So a token can, essentially a debt token can be bound to a particular rating. And then those applications that Dario was talking about could potentially be automated, where you have the pricing of the underlying collateral or the required LTV for the underlying collateral more automatically moving with the credit rating that is being assigned to that particular debt token. So yeah, our vision is, I think we all recognize the transparency that tokenizing RWAs or assets brings and the efficiencies it brings. Essentially, our vision is to give transparency around not just the transaction, but the risk of that transaction. And so that's kind of our focus on in this space. Like I think one example that comes to mind is, like you were mentioning, that now that there are lots of different types of tokens that can be issued in crypto. So you could look at USDE or essentially Athena and look at that, and it's worth $1. And then you have USDC and it's worth $1. But clearly we know that there is a difference between those two assets. Now they both may be really, really safe or both really risky, or they might be very different. But there is at the moment just an abstraction of that away from the user. Currently the user can just sort by TVL or by yield and then sort of allocate accordingly. But there is no consideration that's very easy for the user today to try and appreciate the risk to reward versus just the reward. So that's kind of our vision, is to try and make that part more transparent across the whole on-chain ecosystem.
Yeah, really, really interesting. Go ahead, Dario. You were about to say something.
Yeah, that's interesting, especially when stables starts to the peg and you understand that there's more under the hood than it's just pegged to a $1 value. Do you specialize also in protocols beyond the specific asset? Have you ever considered assessing scoring for protocols in general?
Yeah, I'd say like as DeFi has evolved, like back in 2017, 2020, all of those various eras of DeFi, the majority of assets on lending protocols were commodities. So the risks to be assessed were market risks, like liquidity, price risk, effectively. And now those assets have evolved. Like you look at liquid staking, restaking, private credit, things like structured products like Athena. There's a bunch of stuff with very different risks under the hood. And so we believe like a traditional credit rating approach to those assets is like the natural progression of things for crypto. Ultimately, yeah, the assumption is either there is too much risk or there is no risk, and there's not much in between. And effectively, there is a lot in between, and we're trying to highlight and differentiate between the two.
It's interesting.
Okay. So just to, I mean, we have, because I didn't mention before, but we have Dario that will leave a little bit earlier, so in 7 minutes, and then we can stay here for a Q&A with Darshan and me, like 10 more minutes, and keep talking about this topic. I want to mention like also a little bit, I mean, the benefits, no, for users of this partnership, because till now, I mean, the audience also is maturing a lot, no? We had, I mean, all the DJs, the crypto bros, but finally, I mean, we are trying all in the ecosystem. I mean, not all of us, but at least us, to bring like a better audience here, no? And also to specialize this financial instrument. And I think that really, as Bricken, we are trying really to create the backbone of the tokenization of financial instruments in the space. And on the other hand, you guys, the backbone of the rating, and really giving like a kind of trust of this. No, so actually, if we sum this Bricken plus Credora, I mean, to what we are building here is definitely something that is asset secure, technologically speaking, but also on the other hand, really transparent on credit. So, and this is good because any company can now issue their financial instruments, okay, in the way that the law and jurisdiction are suggesting where is allowed, etc. But in the time they are able to do it, actually they can go to Credora, they can get their credit score, and then see if effectively they can use it or not, if it's convenient for them or not, if they are issuing also something too risky or not. No, this is good to attract a new investor, new kind of audience, really a little bit elevate this kind of assets in the space. I don't know if you guys want to add something, if you have something specific you want to talk about.
I'd say, I'd say like what you're touching on there is, I think with tokenization there is the supply side benefit and the demand side benefit. So for the demand side, like there is just a greater access to opportunities for some people that wouldn't otherwise be able to access this kind of debt issuance. So I think, as I mentioned earlier, for various like costs and operations reasons, the current status quo is you go through large intermediaries who then absorb most of the edge. And as a result, most investors don't get to access debt. And I think what's being talked about there is not like retail necessarily. It could be, but it is like family offices, investors that do have a sophistication that they're looking to diversify their exposure across this market, but they just can't access that deal flow because it's not worth it for the issuer to go and deal with like 1,000 counterparties or 5,000 counterparties. Like the marginal cost of dealing with 5,000 counterparties is too high versus the improvement in the yield. Whereas with tokenization, what that's doing is reducing that. So that I think is like the supply side, where there is some incentive for them to issue debt on chain where they get the distribution and a lower cost base for that distribution. And so it's kind of win-win for both sides is kind of the argument for tokenizing debt in my opinion.
Yeah, absolutely. That was the other point. I mean, it's, yeah, we talk about the audience as retailers, but actually what the places we want to bring in are the family office, I mean the institutionals, where the real money is, and also where the professionals are, because at the end are they making the game, no? Here, I mean, imagine a settlement of money. I mean, here it's taking seconds, no? And it's direct, no intermediaries. I mean, it's straight from me to you, and this is really beautiful. But also on fractional, if we again go back to a retailer, I mean, well, we can take a bond that is I mean, big ticket usually, and we can now fractionalize, no? So open this market also to other kind of audience that before, as you were mentioning, with the cost of the onboarding management, etc., is not worth it, doesn't worth it. But in this case, on chain with this automatic tool and smart contract, definitely it becomes something that can work for the future. Dario, do you want to say something before leaving us?
Yeah, I'm always thinking on on potential features and mechanics that can arise in the blockchain from all of this. The pain of managing many counterparties, for example, can be also streamlined in the blockchain. You have votations, governance. You can really automate things based on token holders' decisions in many aspects, and by governance composed by many people. Um, I think that well, as you said, Ludo, we have been through several eras in the blockchain space, and I think the the world is healing a little bit itself, and we now need credibility, and that's probably where Credora also is pretty much needed. We went through scams and protocols that were nothing to actually build the core foundations of the decentralized finance, and we now need to build systems that are credible in a trusted way. Uh, so I think what Credora is doing here is pretty much essential, and as Darshan said, is also a big step for the next mass adoption.
Yeah, I appreciate that. I think one like analogy to traditional markets that I would draw on is generally like single debt issuances are more liquid in traditional markets than on chain, partly because they have these ratings. But then what increasingly adds liquidity is the standardization of those debt issuances so that you can bundle them together. So if you have like 100 companies issuing debt and you can quantify the risk, you can create like a security that is a package effectively of multiple of those. And then the investor is willing to lend at like a cheaper rate because there is natural diversification of their risk and it's quantified. So you can appropriately tranche and create various debt securities that are bundles of other debt securities. So yeah, I think that it's natural, or it seems inevitable at some stage, that the two technologies that we're working on come together to create that market that's multi-trillion dollars in traditional markets, like where it's cheaper to issue the debt with tokenization, and there is a seamless quantification of the risk of that debt, which allows you to securitize and trade that debt much more liquid.
Beautiful. No, no, it's exactly as you said. Dario, I don't know if you have to leave or not.
Yes, I need to drop off. It's been a pleasure. Thanks, Dasher, for all the insight. Hope to talk with you soon. And Ludovico, I'll see you in the office.
Absolutely. Thank you very much, Dario.
Thank you, everyone. Bye.
Bye. So to the audience, we are before wrapping up. If you have any question, I know we are live on LinkedIn, YouTube, X Twitter. So if you have any question, please go ahead. I already saw some comments, but no questions. So if you have something that you want to explore, please go ahead. Darshan, thank you very much for your time here. It's been a pleasure. I'm really excited actually to really have the first client where we're gonna match all this solution and technology, and we're gonna really show that we have a solid solution. No? We are also working with Chainlink. Chainlink is also doing big steps forward. Proof of reserve, CCP. I mean, all the ecosystem is really evolving a lot. So also as in Bricken, we are, I mean, almost delivering a blockchain-less user experience, almost, because we are not there yet, but it's really easy. And this is also to really involve the people that is not so much tech savvy, but that for sure will enjoy the benefits of this beautiful technology and revolutionary technology that we are working on with. So yeah, thank you, Dasha. But by the way, you are based in Singapore, right?
Lisbon, actually. Lisbon.
In
Lisbon.
Lisbon. But I read that the Credor is coming from Singapore, or am I wrong?
No, we started in California actually, so the other side of the world, and then
Okay. Going around. Okay, yeah, we are definitely close. We are based in Spain, Barcelona. So
nice.
yeah.
I'm excited to bring the solution to our rated borrowers, and I'm sure they'll be really interested in trying it out and issuing debt on Bricken.
Yeah, no, absolutely. That's why it's also a really nice mutual partnership, because we both need each other to really show value. So soon, I'm sure that we will make the right and deserved noise out there. So thank you. Anyway, thank you all of you, audience, to stay here today. Everything has been recorded, so everyone can see it online also in the next days. Darshan, thank you very much once again. You're around for sure, and have everyone a nice day. Bye. Thank you.
Cheers, guys. Bye.